There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB. I'm Juliette Sarli. Great to have your company this Tuesday afternoon where we have taken a little bit of a tumble on the markets, not closing down on the Cboe as much as what we had fallen earlier in the session, and of course some of the weakness that you have seen more broadly on the ASX 200, which is down by around 0.5% today. It is closing out the session just around 8,943, I think. My computer is just having a little think about that, but certainly not quite the positive momentum that we were expecting on the overall market today, and quite a lot of selling coming through from the likes of telco stocks and really only the miners sort of holding up okay. So that's all been about today's Tuesday tumble. At the same time, consumer discretionary stocks coming under pressure, and this is on that sliding sentiment. So Westpac's consumer sentiment index declining 3.5% to a reading of 92.1 in October, so firmly at pessimistic levels, 8 points below 100. Confidence now down 6.5% over the last 2 months, so giving back all of those gains that we saw between May and August. Westpac saying consumers appear to have been rattled by recent updates on inflation and less certain about where we see rate cuts coming. And here comes competition. ASIC approving Cboe Australia's listing market application, meaning that Cboe will be able to list new companies on its platform in direct competition with existing market operators, including the ASX. Quick look at some of the sectoral moves today. I mentioned telcos in particular coming under some pressure. Telstra down 0.8%, Aussie Broadband off by around 0.7%. And I do just need to correct myself as to where the ASX 200 stands as we head into match off, down 0.2%. So it did recover a little in the last half hour or so off that 0.5% drop that we had seen earlier. Consumer discretionary stocks, of course, as we mentioned, coming under quite a lot of selling today. If we have a look at some of those, the likes of Wesfarmers, JB Hi-Fi, there's some of the tech players as well, looking pretty weak today, down about 3%. What else can we show you out there? Mining stocks. Okay, well, of course, we did have some movement coming through in terms of iron ore futures edging higher. Thin trading though. China's markets, of course, closed for the Mid-Autumn Festival public holiday. And just a quick look as well in terms of some of the other stocks we've been watching, with Rio Tinto there planning to invest $733 million with its partners Mitsui and Nippon Steel to develop new iron ore deposits in northwest WA. South 32, look, it had a really good session, up almost 5%. US investing in critical minerals projects. We just spoke to European Lithium. Now remember, this has been on a bit of a tear, so a bit of a take back today, but they're raising $35 million in a share sale of a majority owned firm, Critical Metals Corporation. Really fascinating chat that Andrew just had with the chairman. It will be up on our website shortly. And Greatland Gold hitting a record high on quarterly gold output increase and cost forecasts for the lower end of its guidance. The ASX, though, falling on that news. I told you that Cboe is getting a local listing approval. Drone Shield also giving back a little bit after hitting a record earlier. It's going to invest $13 million over 3 years to build a new counter-drone research and development plan in Adelaide. Web Travel at one point shares up by something like 10%. They've closed high by about 3.5%, but it is posting, or forecasting rather, record earnings for 2026, just showing you how much demand there has been for its web beds business, which allows a platform for travel businesses and agents to find and book accommodation for their clients. And AccuSensus hitting a record high, up 20%. $22.6 million contract win will do that for you. Let's get into some of the broader themes of the day. George Barboris from K2 Asset Management. Good to see you on the COB, George. I just want to get your overall, risk sentiment in terms of what we're seeing, because particularly when you look at what's happening in Japan, I mean, that market is on a tear.
Yeah, Juliette, good to be here this afternoon. Thank you for having me. Yes, I mean, in the local market, while things are fully valued, rolling over, etc., what is happening in Japan in the last 48 hours, or pretty much last 48 hours of trading? Japan didn't have a holiday like South Korea and China yesterday, but it's just doing that catch up because of the policy of the Takaichi trade, or Sanei Takaichi, is pretty much putting pressure on the BOJ to slow the rate hike cycle, targeted fiscal stimulus with PPPs with the private sector and fiscal policy spend. So exactly, it's on the tear, and month to date it's up about 9%. But it's really that yen weakness as well filtering through and being supportive for corporate earnings for Japan, which has got a good technology exposure as an index as well. So there's a number of moving parts. So the rate hike cycle, because they were anti-cycle versus the other central banks, that's going to be pulled back. It's obviously very positive for stocks. The weaker yen versus expectation in the past 2 days, it's obviously good for corporate earnings. And again, that fiscal targeted spend. How it's financed, that's another matter. But it's just that readjustment, and again, it's a bit of a catch-up because it's been a laggard year to date versus other equity bourses.
What do you see, though, in terms of overall global sentiment, particularly when equity valuations, as you point out, trading very much above these long-run historical benchmarks, meaning they're expensive?
Yes, they are expensive, and it's one of those rallies, and whether it's the S&P 500 approaching 22.5, 23 times earnings versus long-run historical benchmarks of, say, between 16.5 and 17. So people find it difficult to spend $23 for a dollar of earnings for US equities versus that long run around that $17 for a dollar of earnings. So that's the issue that people are going to have. Now, very quickly, if I can give a summary of the whole world, is that the amount of spend on AI has been such a significant scale that when they're looking and pricing perfection going forward on the productivity gains, there is some merit and there is some resilience to US earnings, and that starts again in 2 weeks with the quarterly earnings, which gives us that report card, because obviously economic data is on a bit of a pause now. CPI data in the US will be on the pause, and payrolls on last Friday. But very quickly, if you take the valuations outside of the major technology stocks and you go to that Russell 2000, yes, it's had a bit of a rally because of that lower rate environment in the US expectation, but not as low as people think. Valuations a bit more reasonable over there. Now let's quickly go to Europe. Europe valuations, they have rallied, re-rating, but those valuations are a bit more compelling, partly because Germany's into its 3rd consecutive year of a recession and it's been struggling on its earnings. Parts of France have been doing okay, but the heavy lifting has been some of the southern countries in Europe. But Europe is still quite cheap, and that re-rating has got a little bit more to go. And then that's why you've seen the rally in Japan. It's been the outlier that's been underperforming. And when you've got positive potential sentiment and changes to expectations, lower rates, weaker yen, good for corporate profits, it feeds through to that re-rating. So that's very quickly. And emerging markets are just a bit of a pocket. You've got to be very careful. It's not uniform, but there are still opportunities depending which emerging market you choose.
How much further opportunity in gold, George, which is nearing $4,000 US? A really good headline on the AFR saying, look, it's telling us politicians can't be trusted because there's sort of such a FOMO trade happening in gold, really speaking to these concerns about government debt levels.
Yeah, no, it's spot on. And that's a good headline that you've just referred to from the AFR. It basically, that one headline gives you the idea or the sentiment, and that is people are just doing a hedge for volatility. So we all know that gold is an inflation hedge, a volatility hedge. It costs you something to store, yields you nothing, etc. But it's been on that extraordinary tear. Then if you want to sit there and go back to 1997, showing my age, when the RBA was sold its last gold reserves under $300 US an ounce, now it's approaching $4,000. Again, the RBA is not the only central bank that did that. But people are choosing that as that volatility hedge, or that US dollar weakness hedge, or potential geopolitical hedge. It has run to an extraordinary level, but if it's in your portfolio, keep it in there. Chasing it here feels a bit difficult. It has to be paired up. You're buying it if there's another exposure in your portfolio that you're looking to hedge, and you can sort of play it off that way. But it's been an extraordinary performance that has been linked obviously to that US dollar weakness. because it's been a very interesting year-to-date performance for risk assets. And that, again, this is your hedge. US dollar risk assets have been rallying all year, but people have been, that alternative hedge about the gold versus US dollar fiat has been that sort of play from hedge funds and managers in general.
All right, what's next, George? I guess we're just having a look at whether or not we're going to start to see some high-level data coming through from the US if they end that shutdown, and of course earnings too.
Exactly. So the guidance on the US earnings. So remember, year to date, if I can just quickly give people a framework, this is the 4th consecutive year of double-digit EPS growth in the US. Extraordinary, very, very resilient, and the composition has changed. Very quickly, we started this year thinking this calendar year in the US would be about a 12-13% EPS year on year. Then we downgraded it down to as low as 9.5 to 10. It's going to land around 11.5, 12 versus the momentum of the first half. I said a lot and I said it very quickly, but the resilience is there for aggregate US earnings. It's about the guidance going forward. How's the tariff negotiations impacting the earnings environment in aggregate? Because at the moment it's still been quite resilient in North America. So the earnings will be very important. Now, when we flip it to Australia, we've got a very different mechanism. In part, we follow the sentiment. We follow the sentiment of North America, and that's an important element. But our equity bourse is extraordinarily different to the US. And just to reinforce and point out the obvious, that consumer sentiment, if I can target it and bring the conversation there, that Westpac Melbourne Institute Consumer Sentiment Index reinforces why the Australian consumer and the household is so much dictated to by the RBA rate. And that stubborn inflation, now that the CPI sort of government assistance has rolled off, just shows you that there's stubborn core inflation in Australia, and it doesn't warrant the deep cuts to the RBA going forward. And you can see the sensitivity, what that has on Aussie households. And that is going to be problematic for Aussie earnings, despite the positives of the buybacks from the recent reporting period. And that's going to be our differentiation versus, say, US equity and US earnings.
All right, George, it was a pleasure. Great to see you. Thanks. Have a good rest of your day. George Barboris from K2 Asset Management there in Melbourne. Let's get back to, of course, what we've been seeing more broadly with equities, and the stock of the day was, in fact, the ASX, the stock exchange operator. We heard from our experts, Philip Pepe from Shaw and Partners, Rudy Philippette van Dijk from FN Arena.
They haven't been the number one only player in the market for quite a while now, but what is certain is that, and undeniable, is that the market has priced out the premium, and that's on the back of, let's just say, they've shown their weaknesses and vulnerabilities and now for quite a while. So to call the ASX a high quality, high performer is probably out of whack with reality. It's actually a struggling former market monopoly that needs to get back on track.
Well, they've shot themselves in the foot so many times. The technology woes have been well publicised. We had the ASX release where they mentioned the wrong company, put the wrong company in trading halt. It's just another reason not to own the stock. It's not a new reason, it's just another, not a nail in the coffin. It's just, another something else is negative. Okay, well, you shouldn't own it anyway, so who cares? It is a sell because it is yesterday's hero. What we've seen through, this stock should be at all-time highs.
It's true.
It's not, and things will probably get worse for them before they get better.
Let's have a quick look at some of the market leaders today, and we mentioned Greatland Gold there on its advice to the market. South 32 was in there too on that critical minerals deal, up 4.6%, Catapult up 3.3%. To the downside though in the market was Catalyst Metals down 7%, and Reece was trading ex-div down by 3.8%. In the small end of town, Southern Palladium had a good session. AccuSensus we mentioned as well, I think hitting a record on that US deal. And Ionia, Henry Jennings put that attention to me earlier today on some US deals as well. Worth catching his thoughts on that. His interview is already on the website. To the downside in the small end of town, European Lithium giving back and of course undergoing that capital raise, and we just spoke to the chair about 15 minutes or so ago. Tonight, well, if the US government gets its act together, we might get the US international trade balance, but of course the shutdown delaying a lot of the data, including US consumer credit. Tomorrow, the RBNZ interest rate decision, they're expected to cut to 2.75%, just widening the gap between where our interest rate sits and where those across the Tasman sit. And we'll also hear from the Bank of Japan Governor Ueda, which is quite important given what we're seeing in terms of yen movement amid the outcome of the Japanese election. Let's recap where the local market is. Down 0.1% on the Cboe 200. The ASX 200 has fallen a bit more, down 1/3%, 8,956. Bottom performing stocks, as we mentioned, catalyst metals there, but really hard to find a winner in the sector. Just the material space there up by about 1/4%. Other than that, looking pretty red across the screen today. We'll be back to do it all again tomorrow from 9:45 a.m. Eastern. We'll see you then.
The COB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.